Welcome! Today, we are diving headfirst into one of the biggest and honestly, one of the most surprisingly controversial debates in all of corporate finance. And it starts with a really simple question. When a company makes a boatload of money, what should it actually do with it? Sounds easy, right? Well, the answer has split the experts right down the middle for decades. So here's our game plan. We're going to start with that core billion-dollar question. Then we'll get into the two opposing camps, team relevance versus team irrelevance. After that, we'll see what happens when all this beautiful theories slams into messy reality. And finally, we'll unpack what a dividend decision is really signaling to the world. Okay, so let's get right into it. I want you to picture this. A company has just had a killer year. They're sitting on a massive pile of cash, pure profit. And now, the leadership team has to make one of the most fundamental decisions they can possibly make. Let's make this real for you. Imagine you're the CEO. Your company just cleared $1 billion in profit. $1 billion! So what's the move? Do you hand that cash back to the people who own the company, your shareholders, as a thank you? Or do you hold on to it, reinvest it back into the business to build new factories, fund R&D, and chase even bigger growth down the line? Now, in the world of finance, this choice has a formal name. The dividend decision. Pretty straightforward. The money you pay out is called a dividend. And the money you decide to keep? That's called retained earnings. And you got to remember, those retained earnings are like the lifeblood for a company's future. It's the cheapest, most accessible cash they have to fund everything they want to do next. And this, my friends, is where the fight really starts. The whole debate boils down to these two completely opposite points of view. In one corner, you have the relevant school. They say this decision is absolutely crucial. It can make or break a company's stock price. And in the other corner, you have the irrelevant school, and they make this wild claim that it doesn't matter at all. All right, let's hear from Team Relevance first. Their argument is pretty intuitive. They believe your dividend policy isn't just some accounting detail. It has a direct, powerful, and totally measurable impact on how much your company is worth. It's a major league decision. One of the key architects of this view was Professor James E. Walter, and his model gave us a really neat way to think about this. He said the right dividend policy all comes down to a simple face-off between two variables, R, which is the company's internal rate of return, and K, its cost of capital. Let's translate that out of finance speak, because it sounds way more complicated than it is. Think of R as what the company can earn if it keeps your dollar and invest it. And K is what you, the shareholder, could earn if you got that dollar back and invested it yourself. So the whole question just becomes, who's better at making this money grow, the company or you? And Walter's model gives us this awesome logical playbook. If you're a growth firm, let's say a hot tech startup that's earning way more than the market average, the best dividend is zero. Keep every single penny and grow. But if you're a declining firm where investors could easily earn more elsewhere, you should pay out 100% of the profits. Give it all back. And if the returns are pretty much the same, well then, it doesn't really matter what you do. This idea has been around forever. This is the traditional school of thought, perfectly captured here by the investing legends Benjamin Graham and David Dodd. And yeah, the language is a little old-fashioned, but the point is clear. Investors love getting paid. A dividend you can hold in your hand feels a heck of a lot more real than a promise of some future stock price increase. But what if that whole traditional view is just wrong? Let's switch gears and look at the other side of this fight, because they came forward with a truly radical, game-changing idea. This bombshell comes from two Nobel laureates, Modigliani and Miller. Their famous hypothesis basically says this: in a perfect world with no taxes or fees, a company's value comes from one thing and one thing only, its ability to make money. How you slice up that money pie between dividends and keeping it in-house, it has zero, and I mean zero, effect on the company's value. So how on earth can that be true? Well, their argument is built on this brilliant little concept called the homemade dividend. Just follow me here. Imagine investor A owns stock in company A, which pays a $5 dividend. Simple, they get $5 in their pocket. Meanwhile, company B decides to keep that $5. Well, that means the company itself is now worth $5 more, so its stock price should go up by that amount. So what about investor B, who owns stock in the company that didn't pay out? Let's say they want $5 in cash anyway. No problem. All they have to do is sell a tiny little piece of their now more valuable stock, and boom, they've created their own $5 cash payout. And here is the absolute key to their whole argument. At the end of the day, the total wealth of investor A and investor B is exactly the same. One got their cash from the company, the other just made it themselves. And because investors can always create their own dividends, Mogliani and Miller argued that the official company policy is, well, irrelevant. Now, the hypothesis is elegant, it's brilliant, but it's all based on that one little phrase, in a perfect market. And as we all know, the real world is anything but perfect. This is where the theory gets a big old reality check. Which leads us to the million-dollar question, right? If homemade dividends are a perfect substitute, why have some of the smartest people in finance been arguing about this for over half a century? Why do markets still go crazy over dividend announcements? Well, the answer is that reality is messy. Unlike in that perfect theoretical world, we have taxes, and dividends and stock sales are often taxed very differently. Selling stock isn't free. You've got to pay transaction costs and brokerage fees. For the company, raising new money from the outside is way more expensive than just using the cash it already has. And finally, there's just plain old human psychology. A lot of investors prefer the certainty of that bird in the hand, the cash dividend, over the promise of a future capital gain. So after all that, where do we land? Are dividends relevant or irrelevant? Well, the modern thinking is that the debate itself is what's really important. It forces us to see that dividends are about way more than just handing out cash. You know what? It turns out there's truth on both sides. There is no single right dividend policy that works for every company, every time. It's totally situational, just like Walter's model suggested all those years ago. A high-flying growth company should probably keep every dime it can to fuel that growth. But a stable, mature company with fewer places to invest? Yeah, it probably serves its shareholders best by distributing that cash. But maybe, just maybe, the most crucial role dividends play in the real world is this. They are a powerful signal. They are a form of communication. When a company starts paying a dividend or increases an existing one, the management team is sending a crystal clear message to the market. They're saying, look, we are so confident in our future, our earnings are so stable that we can commit to sending you this cash year after year. And that leaves us with one last really interesting question to chew on. When you get that dividend check, is it just a reward for a great year that's already over? Or is it something more? Is it a credible promise from the people running the show about the company's health and stability for years to come? The real answer is probably a little bit of both. And that's exactly why this great dividend debate is never really going to go away.